Good afternoon, everyone, and welcome to Using Technical Analysis Indicators for Short-Term Trading. My name is Gail Mercer, and I'm going to be the hostess for the morning. Now, before we get started, I would like everyone to take just a moment and read over the Nadex risk disclaimer. Basically, anytime you're trading, there is risk involved, and you should never trade with money you cannot afford to lose. Now, for those of you that do not know me, my name is Gail Mercer. I have over 15 years of trading experience. Started out with a company that programmed indicators and really just fell in love with the price bars. I do specialize in price action, volume analysis, and divergence because I believe they are leading indicators. I'm also a frequent contributor to Stocks and Commodities Magazine, Traders World, and Top Shelf. I've also been a speaker at Traders Expo, Traders World Online Expo, and the Wyckoff Volume Conference. I'm also the author of Trading Nadex Binary Options and Spreads Using Candlestick Patterns, Trading Nadex Binary Options Using Currencies, Trading Nadex Binary Options, Keeping It Simple Strategies, as well as the New Trader's Guide to Trading Nadex Binary Options and Spreads. Now, today we're going to be combining two technical analysis indicators. The first one that we will be using is the Ichimoku, and we're using it more or less as a support and resistance indicator. Okay? Now, the Ichimoku it has a lot of information in it, but basically what we're going to be looking at is what they call the cloud. So in this case, you see I have a blue cloud that recognizes an uptrend, and the red is for a downtrend. Okay? Now, anytime the price is above the cloud, generally is considered an uptrend. If price is trading below the cloud, it is considered a downtrend. When you have the price in the cloud, it's considered a flat area, and a lot of people say it will project the future support and resistance areas. Now, there's nothing magical about this indicator. I don't think there's anything magical about any indicator personally, okay? It's just whatever you choose that you understand, okay? A lot of people use this, which is one of the reasons I chose it. So we're going to combine that with the stochastics. Now, the stochastics identifies overbought and oversold. Overbought is anything above 80. Oversold is anything below 20. You can also use this with divergences if you know divergence. For example, you could identify trend divergence or hidden divergence. Okay? So what we're going to do is we're going to combine the cloud with the stochastics. For example, if the cloud is green, then you know you would be going long. If the cloud is red, you know you would be going short. Then we're going to use the stochastics to identify overbought and oversold conditions. If the cloud is green, to take a trade, the stochastic should be oversold. Why? Because the cloud is indicating an uptrend, so you want to get it on the retracement. That retracement would make the stochastics become oversold. Now, if the cloud is red, then the stochastics would be overbought. Do you see how this is just opposite of the direction? So in other words, if you have red on the cloud, then you want overbought. If you're green in the cloud, then you want to be oversold. It's just opposite of the color being bullish, so you want this to show that the market has been bearish. If you want to go short, which is a bearish move, then you would want the stochastics to be bullish. Okay. Now, once that is met, then you want a candlestick reversal pattern. Okay. If the cloud is green, okay, that means it's an uptrend. You're looking for a long position. Then you would want a pivot low candlestick or a bullish reversal candle. If the cloud is red, meaning bearish, then you would want a pivot high candlestick or a bearish reversal candle. Okay. You could also add divergences to this to identify the retracements. It just depends on how complicated you want to get. For example, if the cloud is green, you would want bullish divergence on the lows. If the cloud is red, you would want bearish divergence on the highs. Okay? So here's an example on the USDJPY. The bias is to the upside because the cloud is green. You have a pivot low formation that has occurred. You can also see down here that the stochastics is oversold. Okay? So your anticipation, and I really do believe in anticipating where price will go, your anticipation is that price will retest the high up here at 110.95. Okay? Does everybody understand that? So let's just briefly go over this one more time. You have the cloud is green. Okay? So that means up. We're looking for an upward move. Okay? The stochastics is overextended. And we have a pivot low formation right here, right at the end actually of this bar right here. All of your criteria is met, and so you could take a long position with anticipation that the very top up here would at least be retested, if not exceeded. Okay? Now, when you enter like this, be careful on these little moving averages here because they can act as resistance. Okay? Now, let's see what actually happened after that move. Okay? Do you see how this went straight up? Okay? Now, if you were down here, okay, probably about 110.76. Okay. If you could have gotten, let's say 110.78, the very next bar actually would have produced a profit. Does everyone see that? Any questions on that? Okay, let's go to another example on the British pound. And again, I really do believe that when you take a trading plan and you're looking at a chart, you go through your trading plan and mark it off, especially if you're new. Okay, so the first criteria is the color of the cloud. Okay, in this case, it is red. Okay, that means we will be going short. In order to go short, the stochastics needs to be overextended. Okay, on the long side. In this case, the stochastics is overbought. Okay, here is your 3-bar reversal. Does everybody see that? You have a pivot high right here. This bar did close under the low of that bar. So your anticipation is that price will come back and try to test this low. Again, always watch out for the moving averages. Moving averages can act as support and resistance. Okay? Always make sure if you're in a trade, watch out for those areas, okay? Now, what actually happens, okay? Okay, now the next question is what time frame are you using? Penny, it doesn't matter about the time frame. You could do this on a 5-minute and you could do it on a daily. The time frame is going to affect which product you want to do it with, okay? For example, if you're doing it on a 2-hour binary, then you probably want that set up on your 15-minute chart. If I was doing a 5-minute binary, I'd want that set up probably on my 1-minute chart. If I was doing a 20-minute binary, then I'd probably want that set up on a 5-minute, okay? If I'm doing this on a weekly time frame, like the weekly touch bracket, then I probably want it on my daily or my 6-hour chart, okay? Now, one of the biggest questions is which Nadex product do you use, okay? You've got binary option or call spread. That means that you are expecting a short-term move or a quick move. For example, the USD this morning with the Bank of Canada market report, okay? That would have been one that you could have done a binary option or a call spread on, okay? You want to just be in intraday. You don't want to hold overnight or for hours at a time, okay? Binary option call spread, perfect for those scenarios, okay? The touch bracket, you're expecting a larger move based on a higher time frame like the 6-hour chart, okay? You might be in that for the full day. You might be in that for a couple of days, okay? That's where I would use the touch bracket. Sunday night, we have a forex breakdown webinar, and I was showing people how I really believed the British pound was going to go down on, Sunday night into Monday, which it did. That was a perfect example of using a touch bracket because that move lasted, a couple of days. Now, sometimes when you get these moves on your higher time frames, like your 6-hour or your daily chart, you can't combine them, okay? You can do intraday, you could do the 2 hours, you could do the dailies, you could do the touch brackets, you could do the call spreads. There's one setup that I have that, hey, I might take 6 to 8 trades off of that one setup using different products that Nadex has. And this is just a great example and really highlights, Penny, which time frame do you use? I look at a lot of different time frames, okay? Michael, is the cloud available on NinjaTrader 8? I believe it is, Michael. Okay, now Technicus, in this, again, this is a discussion on time frames. Your technical analysis techniques will work on all time frames, okay? I don't care what time frame you're trading, okay? If you have a technical analysis plan put together, it will typically work on any time frame, okay? The problem is you will have some losses, okay? And you've got to be able to take those losses. A lot of times new traders make the mistake of starting with the shorter time frames, but the shorter time frames are also closer to the market, which means they will give more false signals, okay? Longer time frames generally take much longer to develop, but they also do not give you as many false signals, okay? And it's bigger moves on your higher time frames, okay? Now, from the way that I trade, my time frame is actually a 120, a 60, and a 15-minute. I'm always using the 2-hour binary or call spread when I'm doing that time frame. But if I want to be in for the duration of the move, so like I was for the British pound dollar, then I'm going to use a daily, a 6 hour, and a 1 hour time frame. Okay. Now, I also always measure the expectation. For example, in the British pound dollar, price is trading at 1.3032. Now, I am anticipating a test of the previous low, which is at 1.2772. So my expectation is 260 pips. Okay? That means I'm probably going to use a touch bracket. Okay? Why would I use a touch bracket? Okay? Because that's going to encompass more of the move. Okay? So your risk in this example was $91. Your profit potential was $159. Your risk to reward was for every $1 of risk you would be able to capture if it moved the entire width of the bracket, 1.74. Okay? And this is always what I look at, because let's say that the risk on this was 159 and the available profit was only 91, I'd probably bypass on the trade, because I do measure my risk to reward on every single trade. Any questions? And I did this with the Ichimoku. You could do this with any indicator. The only difference is I had one that did support and resistance, and I had one that showed me when the market was overbought and oversold. And I combined those two with price pivots. Okay? It doesn't have to be the cloud. Pick another one. You can do it with Bollinger Bands. You could do it with Keltner Channel. You could do it with any of them. It's whatever makes the most sense to you. Okay? I choose to use the ATR with moving averages. Any questions? Okay, if there are no questions, I would like to give you the information to visit my website. It's www.TradersHelpDesk.com. You can always email me at gm@TradersHelpDesk.com as well. Thank you for all joining us for the presentation. I hope you enjoyed it, and I hope you sign up for the one on Sunday at 7 p.m. as well.